Ready to dive into the crypto world?
Let's do it.
Good, because today we're talking about what's moving the market right now. Late September 2024, we'll be looking at Bitcoin and Ethereum, obviously, and whether Ethereum really is about to fall below $2,600. Then we'll unpack Caroline Ellison's sentencing and what it means for justice in the crypto world post-FTX. And finally, we're going to explore DeFi, or decentralized finance, the quiet achiever that's actually exceeding expectations while other parts of the crypto world seem to be in chaos. So let's start with Bitcoin and Ethereum. Bitcoin's up 6% this week, hitting $63,000, while Ethereum's seen a bigger jump, up 14% to $2,620. So they're both in the green, but something feels different about Ethereum, would you say?
Yeah, you're picking up on the underlying tension there. While both have seen gains, there's a sense of unease around Ethereum, and it all comes down to the movements of a single whale investor.
Okay, hold on. I need a quick translation. For those of us who don't speak fluent crypto, what exactly is a whale investor?
So imagine a whale gliding through the ocean, right? Its sheer size impacting the currents. A whale investor in the crypto world is an individual or entity holding a massive amount of a particular cryptocurrency. And their decisions to buy or sell have a ripple effect across the entire market. So in Ethereum's case, one of these whales has been selling off a big chunk of their holdings. And it's created this fear of a price drop below $2,600.
So one big player can really shake things up. It makes you wonder about the stability of it all. Is this a sign of a fundamental flaw in Ethereum, or is this just the nature of crypto?
That's a question at the heart of the whole crypto debate. While volatility can be a major concern, it's important to remember that Ethereum isn't just built on hype. It has solid underlying technology and a rapidly growing range of applications that contribute to its long-term resilience. However, understanding these price swings, especially when they're influenced by major players, it's essential for anyone looking to invest.
So it's a bit like riding a wave, exhilarating, but potentially risky. Speaking of risk, let's move from market volatility to the ongoing saga of FTX, which is another story of risk and potential disaster. Just as a quick reminder, the FTX collapse led to an $11 billion loss, and at the heart of it all was Caroline Ellison, former executive at Alameda Research, which was FTX's sister company. Now, what's fascinating is that despite her role, Ellison received a surprisingly light sentence, just 2 years in prison.
Yeah, and Ellison's case really highlights the complexities of navigating the legal system, especially in the context of the crypto world. Her cooperation with authorities was instrumental in building a stronger case against Sam Bankman-Fried, FTX's co-founder, who ended up receiving a 25-year sentence. So her cooperation definitely played a significant role in her reduced sentence.
So it's a case of you scratch my back, I'll scratch yours, even with financial wrongdoing. Does this set a dangerous precedent? Like you can get away with fraud in the crypto world if you turn on your collaborators?
That's the debate raging right now. Ellison's case has sparked a firestorm of discussion about how to punish financial crimes in the crypto space, and it highlights the urgent need for clearer regulations and greater consumer protection, especially with more and more people entering the market.
It seems like the legal system is playing catch-up in this fast-moving world of crypto. It's like we're in uncharted territory and the rulebook is still being written. But let's shift gears from the FTX drama to a sector that's quietly been achieving incredible things, while the rest of the crypto world seems intent on giving everyone whiplash. And that's DeFi. DeFi, or decentralized finance, is exactly what it sounds like. It's a financial system that operates without traditional intermediaries like banks. And while it might seem like a fringe concept, it's attracting serious attention. DeFi Technologies, a leading company in this space, reported a staggering $98 million in revenue last quarter. And that's not a typo, $98 million.
Yeah, what makes DeFi so fascinating is that it challenges the very foundations of traditional finance. Because it's decentralized, it offers a level of transparency and potential for profit that's simply not possible in the traditional system.
Okay, now you've got my attention. Transparency and profit. Tell me more.
So imagine a system where every transaction is recorded on a public blockchain for everyone to see. No more hidden fees, no more wondering where your money is going. That's the promise of DeFi. And because it cuts out the middleman, there's potential for higher returns for investors. In fact, DeFi Technologies has been reporting returns of 8–10% from their staking and lending operations, significantly higher than your average savings account.
8–10%. Those are some impressive numbers. But before I start moving all my money, break down these staking and lending operations for me. What exactly are they? And more importantly, what are the risks?
You're right to be cautious. While the potential for reward is there, it's vital to understand how it all works.
Exactly, and that's what we're here to do. Now, before we delve deeper into the world of DeFi, let's take a quick pause. When we come back, we'll unpack the intricacies of staking and lending and explore whether those high returns are truly worth the risk. Don't go anywhere. And we're back diving deeper into the world of DeFi, where the potential is huge, but as with any investment, so are the questions. Before the break, we were talking about DeFi Technologies boasting these incredible 8–10% returns from something called staking and lending. It all sounds pretty amazing, but let's break it down. What exactly are these operations and what are the risks involved?
You're right to be curious. Higher returns often come with a different level of risk. In the simplest terms, staking in DeFi is like lending your crypto to support a blockchain network in exchange for rewards. Imagine it as adding your weight to a seesaw to keep it balanced, and for your contribution, you get a cut of the profits. Lending, on the other hand, is more like being the bank in this decentralized world. You provide your crypto as loans to other users on the platform, and they pay you back with interest.
So instead of my money just sitting in a savings account, with staking and lending, it's actively out there, potentially earning more, but also subject to the dynamics of this DeFi network. It's a fascinating concept. But how does all of this actually work? Is it just a free-for-all?
That's where smart contracts come into play. They're the backbone of DeFi, acting as self-executing agreements written in code. Think of them as digital vending machines. You put in your crypto and select what you want to do, stake, lend, etc. And the smart contract automatically handles the rest, ensuring fairness and transparency throughout the process.
So it's all automated and out in the open, which is very different from traditional finance where things can feel like a black box sometimes. But what about regulation? It's a decentralized system, so who's keeping an eye on everything, and how can you regulate something that's designed to operate outside traditional systems?
That's the million-dollar question. And the biggest challenge for DeFi right now, its decentralized nature while appealing in its transparency and freedom, also makes it tricky to regulate. However, that doesn't mean it's a complete free-for-all. Different jurisdictions are taking different approaches.
So it's a bit of a regulatory puzzle with each piece trying to find its place. Are there any countries leading the charge in terms of figuring out this whole DeFi regulation thing?
Interestingly, the European Union has been taking a proactive approach. With its markets in crypto assets regulation, or MiCA, they aim to create a more secure and transparent crypto market, and that includes DeFi. They're essentially setting the stage for how these decentralized systems can be integrated into a regulated framework.
The EU taking the lead on something as revolutionary as DeFi, that's pretty surprising. What about the US? They're usually at the forefront of new financial technology.
You'd think so, wouldn't you? But the U.S. has been a bit slower on the uptake with DeFi regulation. While there have been attempts to create a more crypto-friendly environment, the overall picture remains pretty unclear. This lack of clarity makes some institutional investors hesitant, while others see it as an opportunity for innovation.
So it's like a high-stakes game of strategy with everyone watching to see who makes the first move. But let's bring it back to what matters most. You, the listener. With all this talk about DeFi's potential and its regulatory limbo, how do you as an individual even begin to navigate this new world? What should you be paying attention to?
It's all about balancing opportunity with caution. You should be asking yourself, what problem does DeFi solve for me? Does it fit into my risk tolerance? And how can I be sure I'm interacting with reputable platforms and projects? Don't jump in just because everyone else is. Understand the risks involved and do your due diligence.
Don't put all your eggs in one basket, especially a basket you don't fully understand, right? But then again, staying informed is key, which is why we're doing this deep dive in the first place.
Lastly, knowledge is power, especially in a field as complex and dynamic as DeFi.
We're back, and for this final part of our crypto deep dive, we've talked about the highs, the lows, the FTX drama, and even explore the exciting world of DeFi. But before we wrap up, we've got to address the elephant in the room, the risks.
You're absolutely right. It's essential to acknowledge those risks. DeFi is still a young technology, and with any new technology, there are bound to be vulnerabilities.
So what are the potential pitfalls here? What should we be watching out for as we navigate this decentralized world?
Well, one of the biggest risks lies in the very heart of DeFi. Smart contracts, we talked about them earlier, those self-executing agreements written in code that automate everything. And while incredibly powerful and efficient, smart contracts are only as good as the code they're built on. And code, as we know, can be vulnerable.
So there's a chance that these smart contracts, the very foundation of DeFi, could have flaws that hackers could exploit.
Unfortunately, yes, that's a reality. Even with the best intentions and rigorous testing, vulnerabilities can exist. And when it comes to finance, those vulnerabilities can have significant consequences. We've already seen instances where hackers have exploited flaws in smart contracts, leading to substantial financial losses.
Okay, that's concerning. It makes you want to double check the locks on your digital wallet. Are there any safeguards in place to protect against these kinds of attacks?
Absolutely. The DeFi community is very aware of these risks, and there's a constant push for better security measures. Think of it as a continuous arms race. Developers are constantly working on ways to fortify smart contracts, making them more resistant to attacks.
Okay, that's reassuring. But even with the best security, things can still go wrong. What happens if, despite all the precautions, a DeFi platform gets hacked? Or worse, collapses like we saw with FTX?
Right, and that's where the decentralized nature of DeFi, while being a strength, also presents a challenge. Unlike traditional finance, there's no central authority to bail you out, no FDIC insurance. It's a bit like venturing into uncharted territory. Exciting, but potentially risky.
So more individual responsibility, which can be both empowering and a little scary. But that seems to be the ethos of DeFi. More control and potential reward, but also more risk.
Precisely. It's all about understanding those risks and deciding what level of exposure is right for you. That's why education is so crucial. The more you understand how DeFi works, the better equipped you'll be to navigate its complexities and make informed decisions.
It's all about finding that balance between being cautious and embracing the potential.
Exactly. Don't let the fear of the unknown hold you back. But don't jump in blindly either. Learn the ropes. Start small. And remember, the crypto world is a marathon, not a sprint.
Solid advice. As we wrap up this deep dive, what are the key takeaways you want our listeners to remember as they navigate the world of cryptocurrency?
Well, I think first and foremost, stay informed. This crypto landscape is constantly evolving. What's groundbreaking today might be old news tomorrow. Second, knowledge is your best defense. Do your research, understand the risks, don't be afraid to ask questions. And finally, approach DeFi with a healthy balance of enthusiasm and caution. It has incredible potential, but it's not without its challenges.
Great advice to end on. Thank you so much for joining us for this deep dive into the world of crypto. Remember, the future of finance is being written right now. And by staying informed and educated, you can be a part of it. Until next time, keep exploring, keep learning, and keep diving deep.